CEO and Chief Investment Officer, Jeffrey Gundlach. It is a CNBC exclusive, and it is so good, Jeffrey, to have you back with us on a Fed Decision Day. Welcome.
Thanks, Scott. It's nice to be here again. Another busy day, busy week for the markets.
You got that right. What's your reaction here to what the Fed did and what Powell said?
Powell's getting pretty good at scripting. Well, it's not really a script, but conducting these press conferences after the meetings. He starts out, and this is like the third time in a row, but I'm often critical of Fed officials. I think Jay had one of his best press conferences today. He started out with a stick. Basically, it's essentially bring inflation down. We need to bring inflation down. We must bring inflation down. And then he starts to get more dovish as he goes along. And he starts to say things that are reassuring to the markets. And he ends up talking the markets up and, frankly, changing the sentiment, I feel like. Not only did stocks do well during and after the press conference, but we saw some real action in the bond market as well. We've been having a lot of volatility in the credit markets. June was a terrible month for the high-yield bond market and the emerging markets. And then we've had a pretty strong rebound in particularly corporate bonds and the high-yield bond market. And they really got second wind after the press conference today. I think that we have an interesting situation now where markets are priced cheaply enough, thanks to all of what's happened in the past few months, where you're at a starting point for certain parts of the credit market, and I'd certainly say for some of the riskier parts of the stock market, where you're from a starting point where the valuation is such that the possibility of good returns, I'm not talking about in a month, but good returns over a 6 to 12 month horizon have significantly improved. And I think one of the things that was really important was that we didn't get this forward guidance stuff so much as in the past. There was a guest prior to Powell's, to the minutes being released and the interest rate hike. There were people saying that they were hoping that we would get more guidance. And I wrote down in my notes, no, just it, because this guidance is what cost the Fed credibility in the past, kind of promising certain things and promising that certain things wouldn't happen, and then events changed and they had to make them happen. And that didn't happen this time. In fact, they even said meeting by meeting, which I don't think that's a phrase I've heard in a long time. And I like that meeting by meeting. That's what I want. I don't want the Fed to make silly things that are based on backward-looking data, make a commitment to something, and then have all expectations have to be reset. So I thought that was pretty good. So all in all, I actually think this market reaction seems less of a sugar high than the prior two in June and May. It's interesting. Wow. I was talking about Judge a little bit facetiously a couple of months ago. They should just raise 200 and get it over with. And now we have raised 200. You know what you said?
Not all at once. You said paint or get off the ladder. Take Fed funds rate to 3% now is what you told me the last time you were on. Now they've done 75 back to back. That's pretty aggressive.
That's right. Well, they're painting. I mean, they're still on the ladder, but they're actually making progress on the job. And so I think that's a good thing. So what's important now is actually the Fed has to understand, and Jay said this pretty clearly, that these things have a lagged effect. And so now that we've, in under 3 months, moved 200 basis points, we need to wait and see to a certain extent. I'm glad there's 8 weeks before the next meeting, because we'll get 2 full data sets by then, and that'll give us a lot more clarity. One thing that I think people don't talk about, and I didn't hear anything about it anywhere today, and it didn't come out of Jay, is how much the money printing was responsible for all of these dislocations and for the inflation rate. And unfortunately, I believe when an economic downturn comes that's of significance, and this is what the Fed wants to avoid, a downturn of significance, because I think they understand that we're probably going to print more money again. And so, ironically, if you want to have less inflation long term, you want to really avoid weirdly, overdoing it now and causing that more steep recession. So I heard Jay Powell say a couple of things fairly concisely, and I applaud him for that. First of all, he acknowledged that 2.5 is the neutral rate, basically. And he acknowledged that the bond market path that he has now followed, and I've been critical in past meetings, particularly before they started liftoff, that they need to follow the 2-year. Well, since the last meeting, now that they've gone 150 in 6 weeks, the 2-year Treasury yield is down 50 basis points, and the Fed funds rate is up 150 basis points. So there's a 200 basis point swing there. So the Fed is no longer behind the curve. And I think they have to understand that, and I think they do. I think that's what came away and why the markets are probably more sustainably calmed down by this. I think they understand that. Go ahead.
I was going to say, I'm almost stunned to hear you say what you're saying. It sounds, I mean, Jeffrey Gundlach is essentially saying that the Fed has gotten its credibility back.
I think they're at a local high, if not an all-time high, in Jay Powell's credibility. He had some low points there, let's face it. The transitory thing, I think people have beaten everybody in the government up enough about the transitory thing. But looking longer term, I think valuations are pretty good. I think when you start at 1,000 basis points of yield on parts of the bond market, like the triple Cs, we'll round them up to 1,000 basis points. There are parts in the securitized market and bonds where there's realistic returns of 11 and 12%, even if you go into a moderate recession. I think one of the things I'm going to applaud Jay for again is he sort of admitted that he's calling a victory now a mild recession. I've heard him say that the pathway to just an economic slowdown is getting very, very narrow, and hopefully we can just have a mild recession. That's the best possible outcome for all financial markets, would actually be a mild recession and continuous sequential declines in the CPI. It's not going to drop down to 2% next year. It's not going to drop down to the 4s this year. But hopefully it's peaked out, at least on the headline level. We have a little bit of decline in commodity prices. It just feels like a lot of the price increases have stabilized, at least for now. So we need the inflation rate to come down. And if it does, I think we'll be able to avoid a severe recession. We'll just have a mild recession. And that would be a good outcome. That would be a good outcome for investors' portfolios who've been really reeling. I mean, I can talk about what happened since the May meeting. It's a mixed bag. But obviously, on a year-to-date and a one-year basis, a 60-40 portfolio and all kinds of financial assets are really struggling. Interesting to compare where we are now to back in May or March or so, let's call it May, where we're now up 200 basis points from before the May meeting. And it's interesting that we're kind of flat in a lot of markets. Of course, bond yields are up with that happening, but a lot of markets are sort of flat and they're not down an awful lot. So the market has handled this 200 basis point increase pretty well. And in fact, I think it's sort of helped to stabilize it because the Fed is no longer behind the curve. I think they may not be able to get 4 more hikes in this year. I hope they don't do that. That's what is in the work right now. The shape of the yield curve says that maybe 4 more hikes, maybe not even 4 between now and December. So I think we're going to end at around 3%. One thing that I am pleased with, Judge, is in our last Fed day conversation, you asked me about the bond market, and I said the opportunities in the long end of the bond market, and that's actually been one of the better performers since then. So we've gone a long way on that. The long end of the bond market does not look attractive to me at this level because we've had a rally and the Fed is less inclined to really put the hammer down, I think. And so the long end may be drifting higher as we move into year end.
You know, there is one question as to whether the market is underestimating or is too sanguine on really what lies ahead still from the Fed. You know, we have this huge rally today, but even before that, right, Powell says today, quote, strongly committed to bringing inflation down. We have the tools we need. We have the resolve. And I know some have doubted whether, in fact, and you included, whether they did, in fact, have the resolve. They're still going to raise rates. And they want to restrict policy further from here. Now, there may be a lag, obviously, as you mentioned, from the policy that they've already moved, but there's a lot still to come. And I wonder if the market truly is getting that at the moment. What do you think?
Well, I think the biggest part of that cocktail that people aren't really factoring in, and it got little play at the press conference, is the quantitative tightening. I mean, they started supposedly letting assets roll off the balance sheet in June, but it's been very little. It's actually less on a net basis than what they forecast it would be, and they're still ramping up. And they're going to get to a full-on quantitative tightening of about 65 billion in treasuries and 30 billion or so in mortgages, or 35, whatever it is per month. And last time that happened, and the Fed funds rate was at 2.5%, we had December, January 2018, 2019. And that's the biggest headwind out there, is the Federal Reserve is committed to quantitative tightening. And that's another piece of the puzzle. We had massive stimulus with money printing and monetary easing, quantitative easing. Now we're tightening. We've already done 200, 225, and now we're really going to start doing quantitative tightening. And that's going to be a headwind that will continue volatility, I think, and we'll probably see nothing resembling a straight line. But I do think when it comes to investors who were smart or lucky enough to have raised cash and be in a conservative position, there's a lot of investments in the bond market right now that have potential for 10 to 15% IRRs. You're not going to find them in an index fund, but these are the parts of the market that we're really struggling with the Fed kind of almost an automatic pilot concept, and lots of illiquidity that were brought on by that, and of course the summertime and other variables of thin liquidity. The vacation season seemed early this year. People seemed very anxious to get out on the road, and so June was an unusually illiquid period for the market. It feels like it's getting better, not worse, thanks to the Fed's newfound, I think, more on-point rhetoric. So you're right, Scott. I'm actually giving Powell the highest rate of any press conference in his career as chairman.
So let's do this. Jeffrey. Let's take a quick break. Let's come back. I do want you to tell us what some of those best opportunities are in the bond market before we leave today. But we have a lot more to get to with Jeffrey Gundlach, of course, of DoubleLine. After this quick break, we're back on Overtime after this.
We get 3 or 4 sequential CPI declines, I think the Fed will stop hiking. I hope they actually take a pause if there's one decline in the CPI. I hope they pause one of the next 2 meetings. I hope they do nothing, because I think we want to see the aftermath of these rate hikes percolate through. And of course, as I said in the last segment, we got the quantitative tightening coming. So I think we're getting pretty close to the end. We see the yield curve as flat as a pancake. The 2-year Treasury, which I talk about as being the true guiding signal for the Fed, they still won't admit it. They say they look at inflation, which they should, and they say they look at the labor market, which of course they should. But what they're looking at, and I've said this repeatedly, I'm sure I'll say it to you again many times in the future, Judge, they follow the 2-year. And the 2-year Treasury has dipped below 3%. If you use the total shape of the yield curve, it suggests that they're going to 350, and then that'll be it. But I don't think they're going to get there. So that's what I think is going to happen.
Well, we're getting pretty close to the end, is what you just said. And maybe that's what this equity market rally today is sniffing out as well. The question is, along that journey, how much pain they're really willing to inflict. on the economy. And Powell wouldn't really go there today, asked directly by our own Steve Leisman, once again with the question that gets the answer, and he wouldn't commit to it. Leisman tweeting later, the sound you hear of a slamming door is Fed Chair Jay Powell's total, utter, and complete refusal to discuss how the Fed will react to weakening economic growth or a recession. He does not want the market to believe there is any give in this inflation fight. What's your reaction to that?
I'm going to applaud Jay Powell for slamming the door, because the way he gets himself into trouble is to answer hypotheticals, and then the data set that comes forward is obviously not in line with literally in line with any of the hypotheticals, and then he looks all fumbling because he ends up doing something utterly uncontemplated. So who knows how the slowdown is going to look? We already have a slowdown going on in parts of the economy. Housing is obviously slowing down. Consumer demand is obviously going to be slowing down. So there are parts of the economy that way. But I just think that we need to be more truly data dependent, and we'll have to see what happens. There's so much uncertainty right now in what a normal economy looks like because of the massive dislocation of 2020 and the money printing. Job number one, in my opinion, is to make it as improbable as possible that we decide that money printing is a solution for us again, because that's what's gotten us into all of these problems. And I'm talking societal problems, I'm talking inflation problems, I'm talking rancor problems in the political discourse arena. We need to stop printing money. And so I am rooting for Jay Powell. I want him to be able to accomplish a negative economic experience, but not one that is born of autopilot excessive tightening. And that's the answer that he gave Steve. You know, it's nice to try to get clarity. I thought this press conference had more clarity. We know what neutral is. We know where he thinks the terminal Fed funds rate is. We know kind of that he's willing to take a little bit of economic pain. The real problem is, what's the definition of a little economic pain? I think what we're experiencing now, we can experience a little bit worse than what we're doing now. But if we go and if the trap door opens up, we're going to have these Congress people and these governors putting out stimulus checks again, and the inflation merry-go-round is going to go into overdrive. That's the way we get out of it. Is I think it was David Kelly. He's a good guy. He's comes on your network before the Fed meetings, and I like listening to what he has to say. And I thought he said something pretty well. He kind of set the table for that same concept that I'm fond of, and that is, why don't we let these percolate through the system? We don't have to pile drive this economy with another 75 and another 75. We've done the 200. Let's see what happens. We're in sync with the bond market. So I think being as open-minded as possible, which is essentially his answer to Steve, I really do feel that that's not I don't think that's a non-answer. I think that's good policy.
Would I be making too much of a leap to say that whereas Jeffrey Gundlach once thought a hard landing was inevitable, now you've come around to the idea that he can pull off his so-named soft-ish landing that, by the way, he still thinks he can do?
I'm gonna say a crash landing is avoidable. I think that a soft-ish landing is your best case. I probably wouldn't give it great odds. I think we're going to have some noticeable economic distress, but I don't think it has to be really a free fall, because Jay, I think, gets it now that he's in sync with the market. Yes, we have negative interest rates. Yes, there's still odd pricings relative to inflation in a lot of assets. Yes, there's still a lot of dislocations in the housing market, the services economy, the supply chains, all that. But I just feel like the approach that's being taken instills more confidence than where we were a year ago.
You've given, I guess, equity investors the belief, I think, that stocks can continue to do better than maybe we thought not that long ago. You did tease the idea of where the best ideas are within the bond market right now. Let's lean on your expertise for that. Tell our viewers where that is.
Well, being a risk-averse bond investor, I always look for cushions of safety while finding opportunities for premium income. And where that's developed is in the middle part of the credit market. So I'm talking about the double B, single B areas of securitized credit or high yield, which have widened out a lot. They've snapped back some, but if you look for things where if you assume there are going to be some defaults, you assume there's going to be some losses, but you have investments below you that take those losses first. And so if we have a moderate economic downturn, you will have volatility in prices, but you're clipping coupons here in some of these investments that are rated like maybe double B, single B, maybe even very high in the single C category for selected industries. You're clipping coupons that can be 10, 11, 12%. And at spread levels that historically can withstand a lot of defaults and still not have a principal loss to the middle of the capital structure. So investors, it's not easy for investors to do that. You need to know how to rifle shoot, but you're looking for moderately risky credit funds, either in the high yield bond market or in the bank loan market, where bank loans now, you can buy AAA in some parts of the securitized market, in some parts of the bank loan market at discounts to par, and these things tend to gravitate up to par. And we're talking about top quality types of companies, AAA rated tranches in the CLO market, double B companies in the bank loan market. Those are areas, and the way you don't have to be an expert to screen on these funds. Look for funds that are down 12% year to date. That'll be a good place to start. Those have underperformed because credit's been bad. You know, you're not going to find that in my flagship funds because we haven't had that problem. But you go to the more off-the-run things, income funds or premium income funds, you'll see that they're down a lot, and yet they've stabilized, and they're going to be the primary beneficiaries if the Fed manages to get this quasi right.
So let me ask you quickly before I let you run, because I have some developments related to Meta's earnings that I need to get to. EMs, we've talked about that for a few months now. An area that you liked, but you hadn't yet put your toe in the water for the most part. Have you yet? Do you still like it?
No. I think that if you had to make a trade today and you weren't allowed to make another trade for 2 years, I would own nothing but emerging markets, but I haven't bought any. We're underweight in emerging market bonds. Thank God, they've been terrible. The dollar's been very strong. That's been a double whammy. And emerging market equity has just been such a bad performer that I'm not willing to catch the falling knife. I've stayed away. I love it on a valuation basis. I love emerging market debt relative to developed market debt on a valuation basis, but we need the dollar to crack, and I would advise investors to watch on the Dixie Index 105. We've been pushing up. We've been up 107. We're at 106 after the Fed looked a little more dovish. So it's not a big drop, but if the dollar index drops below 105, then it's that moment that you assess how to size the emerging market trade.
All right. It sounds great. I appreciate your time as always. I know our viewers love hearing from you right after the Fed chair finishes speaking after that big decision is made. September is going to be a doozy, I think, and hopefully we'll be talking to you again then, Jeffrey. Thank you so much.
All right. I'll see you in September, Judge. Have a great summer.
All right. Yeah, you as well. That's Jeffrey Gundlach joining us exclusively today. We do have that aforementioned news regarding Meta. Julia Borson just speaking with that company's CFO. Julia?
That's right. I just spoke to Meta CFO Dave Wehner. I pressed him on Meta's top and bottom line miss and also the lower than expected guidance for the third quarter. And he told me that they are seeing the economic cycle have a broad impact on the digital ad business, which is looking more challenging than it was in the last quarter. He also noted that they're seeing a broad-based deceleration across ad verticals and also across both direct response and brand advertising, noting that online commerce remains a challenging category. Now, I also asked him what's next for Meta's investment in the metaverse. He said that they are being more focused on and disciplined on spending both in the metaverse and across the board at the company. But he did say that the metaverse is still a key business that they're investing in for the long term. Scott?
All right, Julia, thank you for that update. It's time for a CNBC News update now with Shepard Smith. Hey, Shep.
Hi, Scott. On a busy afternoon, here's what's happening from the news. The White House has offered a deal to Russia to bring home jailed Americans Brittany Griner and Paul Whelan. No specifics from Secretary Blinken today, except the offer made last month. He did say he's requested a call with the Russian foreign minister to discuss, and if they speak, it would be the first time since the Russians invaded Ukraine. 2 former Minneapolis police officers sentenced to federal prison today for violating George Floyd's civil rights. One helped pin Floyd to the ground. He got 3 years. The other held back the crowd, got 3.5. Both still set to stand trial in October on state charges on manslaughter and aiding and abetting second-degree murder. And the suspect in the 4th of July massacre at Highland Park, Illinois, hit with 110 additional charges by a grand jury today. 7 people killed, dozens of others injured when a gunman opened fire from the roof of a building on the parade route. He also faces attempted murder and aggravated battery charges. The suspect scheduled in court next week. Tonight, Steve Leisman on the Fed decision, gun manufacturers grilled on Capitol Hill, and the name, image, and likeness deals that are changing the face of college sports. On the news, right after Jim Cramer, 7 Eastern, CNBC. Scott, back to you.
All right, Shep, I appreciate that. Shepard Smith, thank you. Up next, more on today's big rally. Stocks soaring on the back of the Fed. New Edge's Cameron Dawson joins us now to break down that move, whether she thinks it is sustainable. That's next.